When the final bell rang out 2017 at the New York Stock Exchange, signaling an end to trading for the year, America's largest publicly traded companies had soared in value for the year, racking up a total return of almost 22%. It was a very good year for stocks. Since the financial crisis bear market of 2008, the year investors lost about 37 cents for every dollar invested in stocks, the stock market has returned a profit for 9 consecutive calendar years. Since the modern era of Wall Street trading began 90 years ago in 1928, 2017 was the 32nd calendar year in which stocks returned 20% or more. Stock prices broke the record high repeatedly in 2017, and the economy surprised Wall Street again and again in the last half of the year. Citigroup's Economic Surprise Index, a running tally of how surprised economists are, both positively and negatively, soared during the last half of 2017, according to the latest data release, and ended the year hovering at record high levels not reached since 2011. A Wall Street Journal article on December 27th warned that good economic surprises must eventually come to an end. Economists will lift their forecasts and raise their expectations until they are disappointed by the latest data and are badly surprised. It's a reminder that investor sentiment is fleeting and could change. There's certainly enough to worry about. Washington is in the midst of a major political scandal, and the nuclear standoff with North Korea could explode with terrifying consequences. Tax reform could accelerate economic growth and push the Federal Reserve to make a mistake on interest rate policy, which would quash growth or allow the economy to run too hot, triggering inflation to surge. It's wise to expect a 10 or 15% plunge at any time, and as the 8.5-year bull market grows older, the likelihood of a prolonged bear market drop of 20% or more does increase statistically. But the economy is sound. Disposable personal income after accounting for inflation rose at a healthy rate according to the latest data, and retail sales are booming. That's key, since 70% of economic growth comes from consumers. Leading economic indicators are signaling a strong start to 2018. The Fed forecast is quite bright. The world economy is growing in synchronicity with the U.S. for the first time in years, and the new tax law is expected to bump earnings estimates higher by about 8%, and earnings are ultimately what drive stock prices. The bull market could well continue in 2018, possibly for a long time, and it could head higher still. As 2018 begins, shares in American companies remain a growth engine in a broadly diversified retirement portfolio. But it is just one component in prudently managing your wealth for the long run. We wish you all the best for 2018. Happy New Year!